Okay, now let's continue with the second part of the chapter, wherein in the first part we have learnt how to determine the residential status of a person as per section 6. So as you know that residential status of a person is a resident and ordinary, resident but not ordinary, and non-resident. Based on that, we have to determine the tax incidence of a person. As I told you, the tax incidence is covered by section 5, 7, 8 and 9. Okay. So the tax incidence is also known as scope of total income. The scope of total income will tell you when a particular income is taxable of a person based on their residential status. Okay. Let's now see the provisions of scope of total income. Okay. So if you see there, this part is covered by section 5. The first part was covered by section 6. 5, 7, 8, 9. 4 sections will be covered in this. I will show you over a period of time what are all which are covered. Okay. Chalo, see here now. Write down scope of total income or incidence of tax, or simply it is called as tax incidence. Simply it is called as tax incidence. Clear what it is? The relationship between residential status and tax incidence is what we need to understand. What is that relationship? Under the Act, incidence of tax on a taxpayer depends upon his residential status and also the place at the time of accrual or receipt of income. So one has to understand what is this place and time of accrual of income and what is this receipt of income. For that, before we proceed with the theory, let me explain you certain things. Income in chapter number 1 is broadly categorized into 5 types, various heads of income which I told you. Income from salaries, income from house property, your PGBP, capital gains and other sources. This is the classification that we have seen for chapter number 1. Okay. Now in chapter number 2, all these incomes we will divide into 2 types. One is known as an Indian income, another one is known as a foreign income. Incomes are broadly categorized into 2 types. One is known as Indian income, second one is known as foreign income. 2 types of incomes is what we have. Okay. Now when an income is said to be an Indian income, when an income is said to be a foreign income is what we need to understand. Okay. To keep it very simple, like you have a salary. If that salary you are working in India, earning in India, receiving in India, it is known as an Indian income. If the same salary you have worked abroad, you are working abroad, earning abroad, receiving abroad, that is known as a foreign income. Okay na? But before you determine that in a general scenario, there is some technicality which is given in section 5, scope of income. Okay, what is that technicality? A income will have 2 stages, accrued and receipt. 2 things you will have in a income. First, a income will be accrued. This accrued can also be said as outstanding, due or arised. All are synonymous words you can say. Arised, accrued, outstanding, due. Second thing is, once a income is accrued, outstanding, due, the second stage of the income will be always receipt. But it need not be that first you should accrue, then you should receive. First you can receive, then you can accrue. Anything it may happen, like advance income, if advance money is there, advance receipt is there, that is known as a first receipt, then it is a accrued concept. Clear? So what do you mean by accrued, arised, outstanding, due? This is nothing but a right to receive your income. It is simply to say, precise word or a simple terminology. It is a right to receive your income is known as your accrued. Second one, receipt, is nothing but when money comes under control. When money comes under control, that is known as a receipt. So there are 2 stages in this. One, you have a right to receive, accrued. Second, when money comes under control. Okay, let's take an example. In this example, like you have a salary income. You know that salary income you receive per month, that every one of you know. Okay, let's assume that salary income which you have per month is something like this, where we have worked from 1st April to 30th April. I worked. Now tell me when the income is said to be due, when the income is said to be received. Income is said to be due on 30th April, which is the last day. And as per legal law, when you should receive is also 30th April. Actually, when the income is due on the same day, you are supposed to receive. Sometimes in a practical life, it so happens that you may receive on the 1st May, you may receive on the 5th May, you may receive on the 10th May, etc. Okay. And in the first chapter, I told you that salary is always taxable on due or receipt basis, whichever is earlier. Not only salary, every income. Under the income tax law, income you have earned or received, whichever is earlier, it will be chargeable to tax. Am I clear? So the very important thing that you need to understand is that when the income is due, when the income is received. So once you have rendered your services, you have a right to receive your income as per the agreement. When the money actually comes in your control, it is a receive and it is taxable on due or receipt basis, whichever is earlier. So remember one point, in your income, you will have only two things. One, where the income is earned or accrued, where the income is received. Based on that, we will decide a particular income as a Indian income and a income as a foreign income. Okay. So as per the definition, when a income is said to be a Indian income, a income is said to be an Indian income in the following three circumstances. A bit, income which is earned in India and received in India. So if you are going to earn an income in India and if you are going to receive an income in India, see, as I told you, there are only two aspects for this. One, where you earn, where you receive. If the earning is in India and receipt is also in India, it is an Indian income, simple funda. Okay. If in a income earned in India and received outside India, earning has been in India, but received where? Received outside India. Still it is an Indian income. And last one, income which is earned outside India and received in India. Still it is known as an Indian income. So if you observe these three cases, what do you got the point? Among earning or receipt, anyone should be in India. If anyone is in India, that will become a Indian income. So then when an income is said to be a foreign income, come on, tell me. When an income is said to be a foreign income, simple funda, income which is earned outside India and an income which is received outside India. So please understand the logic. If the income is earned outside India, if the income is received outside India, both are outside India, then it is a foreign income. So this is what is the Indian income and foreign income is all about. See, in a general scenario, you may have a different logics to say certain income as a Indian income and certain income as a foreign income. But when it comes to the income tax, as per section 5, the scope of total income or tax incidence, the division of income into Indian income and foreign income is purely based on only two factors, where it is earned, where it is received. Clear? Then what department said? For earning, they have introduced a concept called deemed to be earned. For receiving, they introduced a concept called deemed to be received. As I told you in the last class also, if you people remember, deeming is a situation where department is going to assume, ante what is earned, a right to receive. A right to receive is in India, so earned in India. Even though you have not received in India, not right to receive in India, still it is deemed to be earned in India, deemed to be received in India. Those are all certain cases, that not in every case. Department has got logics, and in every case department is right. Department is perfectly right in assuming those cases to deemed to be earned in India and deemed to be received in India, which are given as per section 7 and section 9. Okay, let's go through that theory now. What is earning, deemed to be earned, received, deemed to be received, then I will tell you the tax incidence date. Clear? So let's see the theory. So the question now, Indian income and foreign income. Let's understand Indian income. Any of the following three, as I told you, there are three ways in which it can become an Indian income. First one, income received or deemed to be received in India during the previous year, at the same time it accrues or deemed to accrues in India. So received in India, accrued also in India, deeming also. Income received or deemed to be received in India, accrues or deemed to accrue outside India. Income received outside India but accrues in India. So these are the three circumstances in which it will become an Indian income. Foreign income, income not received, income does not accrue in India. So it doesn't accrue in India. So where does it accrue? Outside India. It is not received in India. Where does it receive? Outside India. Then that income is known as a foreign income. Clear? Receipt of income, how it is understood? Income is received in India is taxable in all cases irrespective of residential status, but following points need to be considered. I will come back to that. Receipt versus remittance, I will come back to that receipt versus remittance later. Okay. Then actual receipt versus deemed receipt. It is not necessary that income should be actually received in India in order to attract the tax liability. Any income deemed to be received in India during the previous year is also included in taxable income of the assessee. What are these deeming provisions? Interest credited in recognized provident fund of an employee in excess of 9.5% of your interest. This we'll understand when we go to salary chapter. Excess contribution of employer in respect of salary to your provident fund. Transfer balance. Contribution by central government or any other employer in account of an employee under notified pension scheme. Tax deducted at source. Deemed profits under section 41. This we will study under PGB. Okay. In all these cases, the money will not be in your control, but it is in your control. Just to understand this, in all these examples what you have, whether it is interest, provident fund contribution, pension contribution. When you go to salary chapter, what happens, you know, employer will do contribution, employee also will do contribution, but employee directly will not do. It will be deducted from his salary and it will be deposited in your PF account. Whose PF account is that? Your PF account. So when it is deposited in your PF account, who received it? You received it. But do you have a control now? No. Because provident fund is one of the retirement benefit which will be paid at the time of retirement. So assessee says, I did not receive it, I don't have any physical control. But understand, it is whose provident fund? Your provident fund. Whose money? Your money. When you will get on retirement. So department says, even though you did not receive now, even though you did not have control now, it is deemed to be received. So that's what are all the cases. Over a period of time when we go to salary chapter and all, you will understand these deeming. Moving forward, accrual of income. Income is accrued in India, chargeable to tax irrespective of residential status. The word accrue or arise is used in contradiction to the word receive. Income is said to be received when it reaches the assessee, when the right to receive the income, this is what is a real word, right, when you have a right to receive the income, vested in the assessee, it is said to accrue or arise. As I told you, deeming provisions are also there for accrued or arise as per section 9. As I told you, all these cases are justified. What are those? One by one. Business connection in India. So if once the business is connected in India, wherever you do the business, as the connection is in India, it is deemed to be earned in India. Income from property, asset, source of income in India. Once the source itself in India, deemed to be earned in India. Capital gain on transfer of capital asset in India. You are selling an asset in India, so it is that. Income from salary if services are rendered in India. There is a golden rule under salary. When we go to salary chapter, I'll tell you there. Wherever you render your services, that is the place where you are going to earn income. Okay, that is the rule. So if you are rendering your services in India, it is deemed to be earned in India, wherever you may earn, wherever you may receive. Income from salary if services is rendered outside India, there is government of India and the employee is a citizen of India. You know, in case of embassies, our Indian citizens will go abroad, they work there in the embassy, but where is your base? You are working for whom? You are working for government of India. So where is government of India? In India. So the base as it is in India, even though you render your services outside India, it is deemed to be earned in. Then dividend paid by Indian company, this is section 8. Then income by way of interest received from government, received from resident, received from resident, where the borrowed money is used by the taxpayer for interest for carrying of business or profession in India. So he borrowed funds, the business or profession is carried on in India. Okay, so wherever, whatever it may happen, it is deemed to be earned in India. Income by way of royalty, technical fees, technical services, if received by government, received from government, received from resident, received from non-resident, where the payment is related to the business or profession or any other source where which is carried on in India. If in these 2 points, if you see, where is the business or profession carried on? Business or profession is carried on in India. Once the business or profession is carried on in India, it is deemed to be earned in India. Okay, so these are all the deeming provisions which you have, even though technically speaking, it may look like it is earned outside India, but it is deemed to be earned in India. Okay, next. So now we have understood 4 terms. What are those 4 terms for taxability is accrued, receipt. Then as I told you, after accrued, deemed to be earned, received and deemed to be received. Okay. Let's understand one more terminology as I was discussing. Receipt versus remittance. Remittance is a word which will be very frequently used in your tax incidence table. Okay, na? Or your tax incidence problems for that matter. So please understand that what is remittance, what is receipt. Okay, listen to this now. In case of a income, please understand that without source, you will never get a income. Okay, let's assume there is a source, there is a person. This person has rendered some services to the source and source has paid a income. Okay, na? So from the source, when you receive for the first time, it is called as receipt. From the source, when you receive for the first time, is called as a receipt. Then what happens, you know, let's assume that person is Mr. X. Mr. X has given this money to Mrs. X, Mr. Small X, Mrs. Small X, Big X, father, and Big Mrs. X, mother. So she is wife, he is son, she is daughter, he is father, she is mother. Now as a responsible person, out of the income 1 lakh which he has earned, what he did, he has given to wife 20,000 for household expenses, 1,000 each for son and daughter for pocket money, then father 10,000, mother 10,000. Now you tell me, this transfer from X to Mrs. X, X to small x, X to Miss, father, mother, is this all a transfer of money, or these all persons have earned money? They did not earn it. It is mere transfer from one person to another person. These are called remittances. And please understand, these remittances are not taxable. Remittances are not taxable for whom? Remittances are not taxable for the receiver, but remittances are taxable for the sender, because for sender it is not a remittance, for sender it is a receipt. So this is another important concept one has to understand. So that's what will be there here. receipt versus remittance. A receipt of income refers to the first occasion, understand this word, first occasion where the recipient gets money under his control. Once the amount is received as income, any remittance or transmission of amount to another place does not result in the receipt or to the other place. So, once you receive for the first time, then only it is income, further transfers are not your incomes. An assessee after receiving an amount outside India cannot be said to have received the same amount again when he brings or remits the same to India. The position remains the same if the income is received outside India by an agent, maybe bank or someone who later on remits the same to India. So, income after the first receipt merely moves as a remittance. So, once you receive for the first time, it is a receipt. After that, it is all remittances. The same income cannot be received by the same person twice, once outside India, again in India. Okay. Another point is income can be in cash or kind. This you know in the base introduction chapter only we have learned. Okay. Both are chargeable to tax. Okay. So, this is what is your residential status. 4 terminologies that we have: income which is received or deemed to be received, income earned or deemed to be earned or accrued or arised. Okay. Now, let us see tax incidence table or scope of total income table. Tax incidence table or scope of total income table. So, this table now explains us the relationship between residential status and tax incidence and on what basis you are going to tax it. That is what it will tell you. Okay. So, let us take columns like this: particulars, resident and ordinary resident, resident but not ordinary resident, and non-resident. Okay, na? First one, income which is earned or deemed to be earned in India and received in India or outside India. This is taxable for all cases because this is which income? This is nothing but your Indian income. Okay. Second case, income which is received or deemed to be received in India, earned in or outside India, then it is taxable for all the 3. So, this is also an Indian income. As you know, either if it is earned or received, if any one is in India, that is an Indian income. Third case, income earned outside India, received outside India. Where you earn? Outside India. Received where? Outside India. So, it is which income? Foreign income. But it is from a business set up in India, profession, business or profession set up or controlled from India. This is known as a special foreign income, taxable for first 2 residents, not taxable for non-resident. Business controlled from India, profession set up in India. For business we use the word control, for profession we use the word set up in India. Okay. But earned and received outside India. Last one, income earned and received outside India. Income earned and received outside India, taxable only for residents, resident but not ordinary, non-resident is not. Okay. This is a normal foreign income. Last, past untaxed profits received or remitted to India. As just now I told you, You see, remittances are not taxable. So, this is overall a tax incidence table, wherein 5 cases we have, where 2 cases are Indian incomes, 2 cases are, this is called as special foreign income, this is normal foreign income, this is other, this is out, is this completely not taxable. So, consider only these 4 cases. If you see there, first 2 are Indian incomes, first 2 are Indian incomes. Irrespective of residential status, you can see the tax table here, all taxables. When it comes to other 2 cases, residence is taxable, non-resident is not taxable. Resident but not ordinary resident, sometimes it is taxable and sometimes it is not taxable. Clear? So, this is what is your residential status tax incidence table. Based on this, we will solve the problems. You can see here, I have given in the material. Income received or deemed to be received in India, whether accrued or earned in India or outside India. This is called Indian income. Taxable, taxable, taxable. Income which accrues or arises or deemed to accrue or arise in India, whether received in India or outside India. This is also an Indian income. If you see there, taxable, taxable, taxable. Income which accrues or arise outside India and received outside India from a business controlled from India or profession set up in India. So, this is taxable, taxable, not taxable. Similarly, income accrue or arise outside India and received outside India from any other source. That is a normal foreign income that you have. Taxable, not taxable, not taxable. Income which accrue or arise outside India, okay, during the previous year, preceding during the previous, remitted to India. Not taxable, not taxable, not taxable. So, this is what is the tax incidence table. So, only 2 things that you need to keep in mind while solving the problem: where the income earned, where the income is received. If income earned and received in India, Indian income, one India, one outside India, Indian income, both outside India, foreign income. In foreign income, special foreign income or normal foreign income. Special foreign income taxable for first 2 cases, normal foreign income taxable in the first case. So, based on this tax incidence table, we can solve the problems. Okay, thank you.